SCHD, the Schwab US Dividend Equity ETF, just announced their Q4 2025 dividend payment, and it came in at 27.82 cents per share, which is the highest quarterly payout for SCHD in their entire fund history. So in this video, we'll be analyzing SCHD, we'll be looking at the fund's entire payout history and looking at the trends to see what we can expect moving forward. We'll be looking at what this personally means for my personal dividend portfolio as well, and also making sure that we have an understanding of how SCHD as a fund actually operates. So let's go ahead and dive in. Now to start, it's no secret SCHD has underperformed the broader market, especially in the last year, currently down by about 5%. Why is this the case? Well, SCHD has very little exposure to tech stocks, and the vast majority of the S&P 500's performance in the last couple of years has been driven by the Mag 7 stocks. In fact, we can now see that the top 10 stocks in the S&P 500 make up over 40% of the S&P 500's market cap. With that in perspective, it's easy to see why we've seen underperformance from SCHD in the past year. But this is something we'll come back and talk about a little bit later in the video. Now, if we jump over to our dividend breakdown sheet and look at the historical dividend payments for SCHD using ticker data, what we can see is a clear trend of those dividend payments since inception back in late 2011 is the dividend payments have grown at a very high rate. And as we'll see, on average, it grows at over 11% every single year. So let's just go ahead and dive into the numbers. Now, this was obviously an important quarter because we now have all 4 dividend payments for SCHD in 2025, so we can look at the annualized data. And so if we zoom in, as we can already see, this was the largest dividend payment ever at 27.82 cents, and the expected pay date is on December 15th. Now, if we look at the quarterly year-over-year growth, it was up by about 5.18%. Again, that's comparing it to the Q4 dividend payment back in 2024. If we look at the annualized dividends for SCHD over the last 4 quarters, it comes out at about $1.05 per share if you round up, which year-over-year growth puts them at about 5.35%. Now, that's definitely below the historic average because if we zoom out just a little bit, one of the things we can see is if we come over here, the average yearly dividend growth for SCHD since inception now is sitting at 11.09%, and since 2019, so a little over 5 years, it's actually 12%. So it's really rare to find a fund that can grow dividends at such an extraordinarily high rate for a prolonged period of time. And one of the things that we've seen throughout this fund's history is anytime we have a year of lower dividend growth, at least compared to the historic average, the following year is typically pretty high. For example, in 2023, we saw 3.7% dividend growth, and the following year was above average. If we scroll down, we can see 7% growth here and 7% growth, but the following year was nearly 20% dividend growth, followed by above 17.5% dividend growth. And if we scroll down even further, we can see for the most part that dividend growth is around 10% or above. So these single-digit dividend growth years for SCHD are certainly not the norm. But let's take a moment and talk about what this means for my personal portfolio. SCHD is a position in my personal portfolio. And as of right now, I'm up about 26% on this position. Now, right now, I own 3,621 shares of SCHD, and with the Q4 dividend payment coming in at 27.82 cents per share, we can calculate exactly what my dividend should look like. It'll come in at about $1,007.36. Now, obviously, this is great. This is a great feeling. But there's obviously higher yielding funds than SCHD. But the magic with SCHD isn't in how much it pays out in dividends right now. It's in how much that dividend payment grows over time when you reinvest dividends and allow dividend growth to take place. Let me show you what I mean to start. Look at this. This is my SCHD quarterly dividend, and this is its share price right now. Simply by reinvesting dividends, I will be able to add about 37 new shares of SCHD to my portfolio. Now, the SCHD dividend for the trailing 12 months is $1.04. Forward looking, obviously, it'll be a little bit higher. But simply by reinvesting dividends, I'm adding about $38.32 to my annualized dividend income, which if we jump over to my dividend dashboard, we can see right now my expected yearly dividend income is $7,479. So simply by reinvesting the dividends, this is going to jump above $7,500. Again, no work on my end. It's simply compounding taking place. So that's great news. If we annualize this number, it comes out to about $153.28, strictly from reinvesting those dividends. But really what's even more powerful is the way dividend growth impacts your future payments from this fund. My yearly SCHD dividends now is sitting at about $3,765.85. So if dividend growth moving forward is the exact same as what we've seen at least since 2019 at around 12%, then that'll add about $451.90 to my annualized dividend income. That is a massive jump up. Again, if we look at where I am right now, that means it's going to be closer to around $8,000 in annualized dividend income when you combine the fact I'm reinvesting dividends and we're seeing high dividend growth. So look at this total added income. Again, I'll zoom out just a little bit so we can see this easier, but this is my added annual income from dividend increases and my added income from dividend reinvestment. Total added income for the year would be around $605. So absolutely, simply just by holding SCHD and doing nothing, by this time next year, my expected yearly dividend income will easily be over $8,000, whether or not I contribute any new capital to my portfolio. And that's not even including all the other positions in my portfolio that are growing dividends at a high rate as well. So absolutely, the dividend growth this year was a little bit on the lower end compared to SCHD's history. So let's address some of the common complaints we're seeing surrounding SCHD right now. From a fundamental standpoint, they continue to do what they've always done in growing dividends at a high rate. I don't think there's really any major complaints there. The major complaint is the underperformance, especially when we've been in the midst of a raging bull market. We're now down around 5% in the last year. Meanwhile, the S&P 500 is up somewhere around that 15% range. Now, obviously, this doesn't include dividends, which would make them closer to breaking even. And with the recent dividend hike, the starting yield is above 3.8%. And so what's the reason for the underperformance? Well, obviously, we're talking about an ETF, so it has to do with the holdings in the portfolio. And if we look at the breakdown of the holdings, we can see they're heavy in energy, consumer defensive, and healthcare. These are sectors that have not performed their best in the last couple of years. So what's the issue? Are the fund managers making poor choices? I saw a lot of people upset a year or two ago when the fund dropped Broadcom, stock ticker AVGO. But here's the mistake a lot of people seem to be making. SCHD isn't just an ETF holding stocks that fund managers are picking, and it's actually a grave mistake to think that's the case. When you buy SCHD, you're not buying just the underlying holdings, you're buying a methodology. What do I mean by this? Well, every single year, SCHD goes through an annual reconstitution. This is basically how the holdings in their fund are selected. And so you cannot consider buying this fund without understanding the methodology. So what's the universe of stocks they could potentially pick from? To start, they select from the Dow Jones US Broad Stock Market Index, not including REITs, so no real estate investment trusts are included. They run 3 initial screens. They look for 10 years of consecutive dividend payments with a minimum market cap of $500 million and 3-month average daily trading volume of $2 million or above. So they want the history of dividend payments, they want the company to be at least a minimum of a $500 million market cap, and they want there to be some liquidity. After they've run this initial screen, they rank them by yield. Stocks passing initial screens are ranked by indicated annual dividend yield, and they select the top 50%. The top 50% are eligible for selection. And then with the final composite ranking, they're ranked by equal weight composite score on free cash flow to total debt. So how strong are the underlying fundamentals? They look at things like return on equity, indicated annual dividend yield, as well as the 5-year dividend growth rate. Once this is done and they have their companies, the top 100 stocks are selected for the index with a 4% cap per stock and 25% sector cap. Currently held stocks are retained if they remain in the top 200 by composite score. So again, this methodology is implemented every single year, so we see somewhat frequent turnover with the stocks that are actually in the fund. So because of the way SCHD is structured, we actually see the underlying holdings change quite a bit every single year. For example, if the financial sector sold off really hard from now until annual reconstitution in March, that would mean that the starting yield for a lot of those companies would be substantially higher, making it likely that they could meet SCHD's requirement into being in their index. But unfortunately, with the recent market conditions, because tech stocks continue to climb higher and higher, their yield goes lower and lower, which again has made SCHD's exposure to tech companies quite a bit lower. This is why if you consider yourself a long-term dividend growth investor like myself, Depending on your circumstances and your goals, SCHD probably isn't an all-in solution. For example, I do want tech exposure in my portfolio, and it's why some of the largest positions in my portfolio are Microsoft, Visa, and Broadcom. These are stocks growing free cash flow at a high rate and as a result, growing dividends at a high rate. So how should we be looking at and considering SCHD right now? Well, there's really two different trains of thought. Everyone in the market right now is obsessed with AI, and rightfully so. It's going to certainly change the economy as a whole tremendously over the next decade. And again, like we saw earlier, it's why the Mag 7 stocks have outperformed by such a wide margin over the last few years. The question you have to ask yourself is whether or not you think we're currently in a bubble. If you think that the AI stocks are still fairly priced, and you think they have plenty of runway to continue to grow in the future, then from an opportunity cost perspective, there's probably better opportunities than SCHD on the market. On the flip side of this, if you do think there is a potential AI bubble, SCHD is certainly something you can consider as a safe haven asset. That doesn't mean there won't be pullbacks with SCHD, but as an example, during 2022 when we had the bear market hit, SCHD price dropped by about 6.5%. Meanwhile, the S&P 500 dropped by around 20%. And then if we switch it and look at it on a total return basis, we can see even more outperformance from SCHD, which only dropped by about 3.2%. S&P 500 around 18.6%. So to some degree, it could be considered a hedge. Now, with all that being said, underperformance is not what we've typically seen throughout SCHD's history. Really, it's only happened in the last few years with the AI boom. Let me show you an example. Even though SCHD has only existed since late 2011, the underlying index that the fund follows, the Dow Jones US Broad Stock Market Index, has existed for far longer. So how has this index performed versus the S&P 500 over a longer time horizon? And this is where the results are actually quite shocking. If we look at the growth of $100,000 of the Dow Jones US Dividend 100 Index versus the S&P 500 starting in 1999, 2002, and 2006. Up until around the beginning of 2025, the Dow Jones US Dividend Index actually outperformed in all three instances. So let me leave you with this. If you're planning on abandoning SCHD right now, I think it's really likely that you didn't understand how the fund was structured in the first place. Now, that being said, you need to evaluate your personal goals and your risk tolerance, because with that being said, SCHD might not be the best fund for you. We always have to look at things through the perspective of a risk to reward scenario. And while I personally absolutely want exposure to some of these amazing tech giant stocks, I do think we absolutely have to be aware of the fact that the top 10 companies in the S&P 500 now make up over 40% of the entire market cap. So go ahead and let me know what you think of SCHD in the comments down below, and if you'd like to be able to download this spreadsheet for your own use, then you can do so for free at the link in the description. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.